Review of provisions, what does that mean? It says that provisions are reviewed each year and adjusted to reflect current best estimates. Um, so what happens that at the end of every year, you create a provision. So let's suppose that in the year 2023, you say that how many telephones did we sell? We found out that we sold 5,000 phones, and we expect that there is a 2% probability that these phones will come back in warranty, and each phone, when it comes back in warranty, it will require $100 of our expense. So we create a provision of $10,000 at the end of 2023. Our double entry should be debit profit and loss account. So we record the warranty expense in the profit and loss, and we say credit provision. Okay. So let me just make this double entry for debit P&L 10,000. And I would say credit my provisions, which go to statement of financial position, balance sheet as a liability 10,000. This is what we expected, that this is the provision we need to have at the end of 2023. Then comes 2024. Okay. End of 2024, you are sitting again and you say, okay, how many telephones did we sell in this year? In 2024, you find out that we sold 6,000 phones this year. We have sold more phones. And your estimate about provision, last year it was 2%. This year it can maybe 1%, maybe 3% based on the last year data. You suppose that it is the same estimate. You say, no, it is the same estimate. And again, you have to multiply it with $100. Let's suppose these estimates do not change. By the way, they can change as well. Instead of $100, you say, based on my recent experience in last year, this expense is not 100. Let's call it $120. Okay. Let's call it $120. And let's find out now. So I will say 6,000 phones multiplied by 2%, and then multiplied by 120. So what I need is 14,400. 14,400, and then adjust to reflect current best estimate. So it means that 10,000 I already created last year. This was I already created. This year I only need to create the difference, 4,400. So now I will make a double entry, debit P&L, 14,400, sorry, 4,400. 4,400, because 10,000 was already there, and credit my provisions, which is 4,400. It is possible that your estimate goes down, so then you have to, reverse the transaction. For example, in 2025, end of, which is not yet arrived, but let's suppose at the end of 2025, you say how many telephones we have sold. Oh, this year we have sold 6,000 telephones again, but we estimate that our provision should be, our warranty probability is only 1.5% because these telephones are doing good, and the expense on the telephone is also less. We are not spending so much. So let's see how much do we need on the new estimate. 6,000 phones into 1.5% into $90. So you need $8,100 in provision only. $8,100. You already have got 14,400. Now, this is a time you have to reverse the provision. And when you reverse the provision, you should say, because you have to decrease, because the total amount of provision which is required at the end of 2025 is 8,100. But your opening balance is already 14,400. 10K plus 4.4K. This is already which you have on your balance sheet, but you need only 81. So 8,100. So 14,400 minus 8,100, you have to decrease your provision. You have to decrease your provision by 6,300. So you would say debit provision 6,300 and credit my profit and loss account. So what is this transaction is going to do? This transaction is going to decrease your provision amount in your balance sheet, and this is going to take a credit in the income statement, and it is actually going to increase the profit in the profit and statement of profit and loss, because you are crediting the P&L. When you credit the P&L, your profit is increased. Okay, so this is how you keep on reviewing. So end of every year you make some provision, then you compare it with the last year. If any increase in put if any increase is required, you will say debit P&L, credit provision. If you have to decrease the provision, you would say debit provision, because provision is a liability, and liabilities are decreased by a debit and increased by a credit. Okay, remember that provision is a liability. So if you have to decrease liability, you make a debit. If you have to increase liability, you make it a credit. So this is what it says, review of provision. If it is no longer probable that an outflow of resource embodying economic benefits will be required, the provision is reversed. You can reverse a part of that provision, which I just did, 6,300. Maybe you don't need, you say nothing is required, then you can reverse it fully. It depends that how much amount do you want to keep in provision. Then you say present obligation and obligating events. So what are the obligating events? We said that in the beginning that it is about present obligation. Okay. So what is a present obligation? Present obligation, it originates from the obligating events. Obligating events means those events which are creating an obligation for you. So present obligations and obligating events, a past event which leads to a present obligation, like signing a warranty. And what is very important is that obligation is there. You understand obligating event, but what is very important that the entity has no realistic alternative to settling the obligation in any other way. So you don't have any other way to settle the event. If a customer comes in and brings this telephone, you cannot say that, take it to someone else or do it someone else. You have to do it. You don't have an alternative to avoid that obligation. So obligation is there. So what this sentence says, that no realistic alternative to settling that obligation, means that you cannot avoid it. You have to do it. In rare cases, it is not clear whether there is a present obligation or not. So in these cases, a past event is deemed to give rise to a present obligation. Sometimes you don't there are some situations which are complex in real life. So it is hard to understand that whether this event brings me some under obligation or not. So in that case, you have to see the past experience, what happened in past. Legal and constructive obligations, I did make a small discussion on this thing when we make the introduction of this topic, that legal obligations are those which are contractual obligations. But sometimes you do have obligations which are not legal, which are not contractual, but they are constructive obligations. It is important topic, constructive obligation, which means that I'm not legally bound to do something, but I have a constructive obligation in the sense that when an entity, it creates the expectations for other parties by its behavior, by its past actions, by its the way it communicates. So even if there is no legal obligation, but you have promised someone something verbally, to your employees, that because remember, I'll just give you an example for constructive obligation. Why does it happen? Imagine that the company is not doing good, or probably the company is doing good, but some people, they want to leave and they've got some better offers. But then you tell them that, what, we are going to make some expansion, and we will be increasing the capacity, we will be opening the new branches, or maybe we will be setting up a new facility, and this business is going to do really good. So a lot of people, they otherwise they might have left you and went somewhere else for better offers, but they stayed with you because you communicated a plan to them. And that was a realistic plan, and that was in a detailed discussed plan, which was agreed by the board, and which was communicated properly. So maybe some people, they might have stayed with you because of those words. Now you don't have a legal obligation to do that, all of that expansion, but actually you have a constructive obligation in the sense that you actually gave some people some expectations to stay with you. So this is one example of constructive obligation. Okay. Another example I gave earlier as well in terms of bonuses. So some companies, they give bonuses. So you give me very little salary. You know what? I usually, you are giving me $3,000 per month, which is very little. I don't want to work with this salary, but I know that this company every year, end of the year, they give some huge bonus. They give $10,000 bonus every year. So I keep on working with this money because I know that every year you give bonus. So in anticipation of that bonus, I'm working with you. But then end of the year, you say I'm not giving bonus. It's not fair because you know what? You have shown from your past behavior for several years in past that every year you give, a bonus which is equal to 3 times of the salary. So I'm probably compromising on my salary just in the hope that I will get 3 additional salaries at the end of the year. So that's a constructive obligation because you have been doing it for so many years. So then you have to do that. Okay. So although you are not legally bound for that, but there is a constructive obligation. This is what is called constructive obligation. An obligation can either be legal or constructive. A legal obligation is the one that derives from a contract. A constructive obligation is an obligation that derives from the actions of an entity where an established pattern of past practice, every year you were giving bonus. Published policies, probably there is no contractual thing, but maybe it is a policy, maybe it is a past practice, maybe this one, maybe this one. The entity has indicated to other parties that it will accept certain responsibilities. We are going to increase your salaries. Okay. As a result, the entity has created a valid expectation in other parties that it will discharge those responsibilities. So, actually, for constructive obligations, there are few more details as well, which I'm not discussing here. Um, I mean, when you go into deep detail, that does it really comprise of a constructive obligation or not? It might have some micro scenarios as well, detailed scenarios, which are not part of this discussion. But you should remember that if an entity, it creates a valid expectation to other parties, then you call that they have a constructive obligation. How do you measure? Measurement. The amount recognized as a provision is the best estimate of the expenditure required to settle the obligation at the end of reporting period. 5,000 phones multiplied by 2%, multiplied by $100, whatever. This is the best estimate which is available. Provisions are discounted where the effect of discounting is material. What happens that sometimes, for example, if I take a building on lease and then okay, we are a bank, okay, and we take a big one floor, big in some business center, which is one open floor. A bank cannot work in that open area. What we do that we start building some compartments, some cubicles, maybe some place for the safe, maybe some place for the customers area, some place for the managers, for someone. So the whole big one area, which was given to us in this form, we made a lot of partitioning in that. We did some, I don't know, some structural changes to make it suitable for us. We have a 5 years lease plan. After 5 years, the contract says that you have to return it back in the original condition because this is what we did according to our needs. If we return it back as it is to the landlord, he might not be able to give it to rent on someone else because maybe the next customer is going to be a car dealer. A car dealer does not need this stuff, he needs open space. So this place is so the usually these rental agreements say that you have to bring it back to the original condition. I know that I've made this structure and I know that at the end of 5 years, I would need to spend maybe $10,000 to remove all of these structures and bring it back to the present condition. But this $10,000 I do not have to spend today. This $10,000 probably I will need to spend after 5 years. So what I need to do, I need to find out the present value of this amount. I have to discount it. And how do you discount that? You will say $10,000 divided by 1 plus your discount rate. Discount rate is probably 10%, let's suppose. So if it is 10% and I put a power 5 and I find down what is the value, maybe the value is $7,000. So this is the provision I need to create. So I will not create a provision with $10,000. I will always create a provision with the present value when the provision has to be paid after some time, when provision has to be settled after a period of more than 1 year. So if it is more than 1 year, you need to record provision at the present value. Okay. So we find out the present value. Uncertainties: if the provision involves a large population of items, which means this can happen, that can happen, then you need to take the expected values, taking into account the probability of all expected outcomes. For example, there is a possibility that I have to settle the provision with an amount of $8,000. I might have to, spend $10,000 or probably $12,000. I'm not sure. These are three possible options. And this has a probability of 0.4. This has a probability of 0.4. And this has a probability of 0.2 only. The sum total of probability should always be equal to 1. So that makes me 3,200. That makes me 4,000. And that is actually 2,400. So you make a total which is 600 and 3,479. 9,600 should be. So this is what is called expected value. Expected value means when you take the value of an event, multiply it with the probability of that event. So your provision should be 9,600. This is called expected value when you have multiple options. But sometimes you have a single obligation. So single obligation is measured on most likely outcome. Single is measured on the most likely outcome. What is the most likely outcome? Either this one or that one. So whichever has the highest probability, you will take that event. Okay. So, this is about the measurement of provisions. Then we have, finally, for conclusion, the decision tree. It's nothing different. It is the same three criteria. We are revising it again once more so that you don't forget that when do you recognize a provision? So a provision, we said that there are three conditions: probable outflow of economic benefit, reliable estimate is available, and it is present obligation. So you have a present obligation, yes. At outflow is probable, yes. You have an estimate, yes. You provide. Provide means that you create a provision. You recognize. You say debit, profit and loss account, credit provision. If any one of these conditions is missing, it is present obligation, possible obligation, maybe it is remote. Remote means that when it happens, it's a very rare chances and it's too far in the future. You do nothing. But if any one of these conditions are missing, you disclose. It is called a contingent liability. So any uncertain liability which meets the three criteria is called a provision, and it is recognized in the financial statements. Those uncertain liabilities which do not meet the three criteria, they are called contingent liabilities. They are not called provisions, they are called contingent liabilities, and they are disclosed in the financial statements. Disclosed means that they are not included in the profit and loss and the balance sheet. You don't make a debit and credit, but you do write down as an additional note into the disclosure note so that you are providing some information to the shareholders. See, the purpose of financial statements is to provide information to the users of the financial statement. And you provide information through the financial statements, through numbers. But sometimes it is not possible to put numbers. For example, we have a legal case going, and it is not decided on 31st of December. And I talk to my lawyer that what do you expect? What could be the reliable estimate? How much fine the court is going to ask us to pay? Is it going to be 100,000? He says no, I cannot estimate it, because in certain situations, sometimes the court says 100,000, sometimes they say 200,000. We are not sure. We cannot say that. In some cases, you can show that, okay, according to the section this of law, this, and section that, this is how they will calculate approximately, this is what can happen. Sometimes you can estimate, sometimes you cannot. So if you cannot estimate, I'm sitting here, so I ask my lawyer, I have to put a debit and credit, what amount should I write? 100,000 or 200,000? And he says, I cannot tell you. So if you cannot tell me, I'm not putting a double entry. I'm not putting a double entry. So because estimate is not available. So what I do, I disclose, which means that I will not make a double entry into the balance sheet and income statement. I will write down to the as a disclosure note so that I can tell to my shareholders that this is a legal case which is going on. Because we do not have an estimate, so we are not writing it down in the income statement, but you should know so that you have information so that tomorrow when this decision will announce, you should not be surprised and you should not be asking us that where did this come from? Why should we pay 100,000 or 200,000? So I'm just giving you information. So this is another way of giving information through disclosure notes. Yes, if it is a remote thing, that's something which happens very late in future or probably with a very little chance. It's remote is something which has a very little chance of happening. Then you do nothing. You do nothing means that you don't put it as provision and you also do not disclose as contingent liability. You just keep silent because you expect that it is remote. There is a very little possibility that that this thing is going to happen in future. So we just keep silent. So this is what the provision are all about.